you want to make money, you need to take some risk. That's a fundamental principle in finance. So let's talk about the relationship between risk and reward. In financial markets and money-making opportunities in general, risk is directly tied to reward, which is often referred to as return. The relationship between the two is a positive correlation, meaning they move together. If you increase your risk, you increase your return. And similarly, if you decrease your risk, you decrease your return. But here's an important concept about this relationship. It goes both ways. Two things are true here. In search of higher returns, you'll be taking on more risk. If you're going to take more risk, then you better be rewarded with higher returns. What this tells us is that an investment or business opportunity with the potential for above average returns but below average risk does not exist. And if it does, everyone will jump into the opportunity until the return matches the risk. This has implications for us because we all have our own individual tolerance for risk. How comfortable are we with uncertainty and volatility? The relationship between risk and return dictates if our risk tolerances are different, then so are the expected returns of our financial decisions. And that can be seen in the various types of investments available to us. On a generalized spectrum of risk from low to high, you have cash and cash equivalents like checking and savings accounts, certificates of deposits, money market funds, and treasuries. You then have various types of bonds, the total stock market, ETFs, and commodities. And then you have those individual stocks, alt assets like crypto, and venture capital private equity for higher net worth people. Now recall the positive correlation between risk and return. What we find is that this ranking of assets by risk is also the ranking for expected returns. Our cash sitting in a bank earns very little interest, but our stock investments have the opportunity to generate double-digit ROIs, if not more. So, depending on someone's risk tolerance, they might be here or they might be there, or usually a combination of all of these. Let's look at a simple but powerful example of how risk is rewarded. Assume a person has $10,000 to put somewhere for 30 years. They have three options, A, B, and C. Option A is to deposit it in a checking account earning 0.1% interest. Option B is to invest it in a 30-year treasury bond at 4% annual return. And option C is to invest it in an S&P 500 ETF expected to earn 10% annually. Here's the results of each. Option A will be only around $10,300, making $10 a year. Options B results will be roughly $33,000, or about $770 per year. And option C will have grown from $10,000 to almost $175,000. That's $5,500 a year. Now, you might be looking at these numbers and think that the decision is obvious. I would rather have 100,000 than 300. But you have to remember, there's no free lunches here. The trade-off for the higher payday is the guaranteed returns. And how big of a trade-off we're comfortable with goes back to our risk tolerance. So how do we gauge that tolerance? Well, first, what is risk in the context of this conversation? Risk means a ton of things because there's different types of risks that impact different investments and different businesses in different ways. To name a few, there's market risk, inflation risk, credit risk, interest rate risk, liquidity risk, regulatory risk, and geopolitical risk. All of these contribute to the overall risk of a financial decision. For assets that can be measured by how frequently and how violently their prices can change, we call this volatility. For business ventures, overall risk is the probability of losses. When we talk about putting our money to work, a baseline goal is to preserve our principal. That's the initial money we're bringing to the table. Preserving principal is another way of saying don't lose money. So going back to risk, there are potential states of the future in which our returns are not only less than what we expected, but also negative. Take the equation of money in times a growth factor generates money out. Since risk introduces the possibility of losses, there's a chance this growth factor is a negative return, which means the money out is less than our money in. We've not only failed to make money, but we've also failed to preserve our principal. So risk tolerance really comes down to questions like these. Do you have the emotional strength to watch your investment portfolio dip 40, 50% on any given day? Can you stomach the probability that you make $0? How about losing money? Do you require guaranteed returns no matter the state of the economy, the market, or geopolitics? How important is it to you that your assets maintain their value at any point in your life when you're finally ready to convert them to cash? Because there is no reward without risk, and vice versa, the answers to these questions will determine which investments in other ventures like business ownership are right for you. To earn higher returns, we need riskier assets. To take on riskier assets, we need higher returns. They are forever tied together and are the fundamental push and pull of making more money. All right, let's leave it there, y'all. Another quick one, but hopefully you found it helpful. If you like this type of video, be sure to like this video and subscribe if you aren't already. In the description, you can find my emails for general questions and one-on-one financial coaching if you're interested. But as always, thanks for watching. Until next time, take care of yourself and best of luck.